Welcome back to The Explainer. Global finance usually grabs all the flashy headlines, right? But the true heartbeat of human prosperity actually lies somewhere else entirely. It exists within the invisible architecture of the domestic economy. So today, we're going to unpack exactly how that hidden machinery works. We're breaking down the structure of local economic systems, looking at the very institutions that literally turn trust into the lifeblood of a nation. Okay, let's dive right into this with a really fundamental question. Think about it for a second. How does a country actually circulate its wealth? Or better yet, how is trust maintained when millions of complete strangers are interacting, trading, and doing business with each other every single day? I mean, it's not magic. It requires a highly coordinated, unified engine to drive national development and keep society stable. To understand how this whole thing works, we've got a clear blueprint for today. We're starting with the architect, moving into the circulation system, uncovering the credit factory, examining the safety net, and finally looking at the digital upgrade. Let's get into it. So, part one, the architect, the central bank. If you think of the entire economy as this complex, heavy-duty vehicle, the central bank is essentially the driver. And this isn't exactly a new concept. The roots actually reach all the way back to 1694 with the establishment of the Bank of England. Over the centuries, it evolved from those early days into the absolutely critical modern institution we know today. It's the invisible architect of economic confidence, and it stands as the ultimate lender of last resort when the whole system gets stressed. Now, the central bank basically has three essential dials on its dashboard. First up, maintaining price stability, so controlling inflation. Second, ensuring the stability of the entire financial system. And third, supporting sustainable growth. Remember that vehicle metaphor we just talked about? Well, money is the fuel. The central bank adjusts interest rates and uses open market operations to basically regulate that fuel. If there's too little fuel, the vehicle stalls out, but if there's too much, the engine risks overheating. Their job is to make sure it's a smooth journey for the entire nation.
Moving right on the engine block, we arrive at part two, the circulation system, commercial banks.
So if the central bank regulates the fuel, commercial banks are the circulation system actively pumping it out. They perform this vital, almost magical trick called maturity transformation. Just think about your own checking or savings account. You make a short-term deposit, fully expecting to be able to withdraw that cash today, tomorrow, or literally whenever you need it. Well, the bank takes those scattered, short-term savings from thousands of households and completely transforms them into long-term capital. We're talking 30-year mortgages for a new home or a massive loan to finance a new factory. The absolute crucial point here is that idle money doesn't just sit around in a vault gathering dust. Through careful credit assessment and broad diversification, banks safely manage the risks of this whole maturity transformation process. They ensure those scattered savings are constantly mobilized and put to work exactly where they can generate the highest productive value for society.
Which brings us perfectly to part three, the credit factory, loan systems.
Okay, we're transitioning to what might be the most surprising reality of this entire explainer. Commercial banks don't just move money around. They literally create it. Money is continuously created through lending and destroyed through repayment. Now, that is a mind-bending reality for a lot of people. We tend to think of money as this fixed, limited resource, like gold coins sitting in a treasure chest. But modern money is not a fixed pie at all. It's a dynamic, constantly flowing force.
You probably know this concept as fractional reserve banking. It's a system where banks are legally allowed to lend out way more than the physical cash they actually hold in their vaults. When a bank issues a loan, it doesn't just transfer existing money from someone else's account into yours. No, it simply creates a brand new deposit right in your account. A super helpful mental model here is to imagine a massive library where the librarian is allowed to just print brand new books whenever a trustworthy borrower asks for one. That's exactly how credit creation works. It expands the effective money supply, fueling investment and entrepreneurship way, way beyond the rigid limits of physical currency.
But as incredible as this engine is, every journey has its hazards. Part 4. The safety net. Insurance. Every new business venture or investment carries some level of risk. So to manage this, we use risk pooling. Think of it as a localized buffer system. If a community pools a fraction of their capital together, a sudden catastrophic loss for one business, like, say, a fire, is absorbed by the collective pool. By collecting small premiums from a ton of participants, insurance effectively transforms these unpredictable, devastating shocks into manageable, shared costs. Historically, organizations like Lloyd's of London actually institutionalized this safety net centuries ago. And why does this matter to us today?
Well, because without this mechanism, the sheer fear of total financial ruin would paralyze us. Insurance ensures that no single disaster can completely destroy an individual's or a business's future. It provides the financial courage that allows entrepreneurs to innovate and families to invest with absolute confidence in an otherwise highly uncertain world.
Finally, we reach Part 5, the digital upgrade, financial inclusion. We've looked at the traditional architecture, but modern technology is completely rewiring this engine as we speak. Historically, access to this infrastructure was pretty much a privilege of the elite. If you lived far away from a major financial hub, you were effectively locked out of the system. But look at the stark contrast in the digital age. Innovations like mobile finance, such as M-Pesa over in Kenya, have allowed millions of previously unbanked people to save, spend, and access credit using nothing more than a basic smartphone.
So, the huge takeaway here is that financial inclusion is the true democratization of money. It transforms capital from a restricted tool meant for the few into a shared infrastructure of opportunity for the many. By actually integrating all citizens into the formal economic system, nations dramatically improve their fiscal capacity and they finally unlock the full economic potential of their populations.
So, we've seen how this absolute masterwork of coordination operates. We've gone from the stewardship of the central bank, down through the credit factories of commercial banking, protected by the safety nets of insurance, and supercharged by digital inclusion. These institutions work perfectly together to literally turn trust into the prosperity of a nation. But here's the thing. Having a finely tuned engine is really only half the story. The ultimate question is, where do you drive it? How do governments actively utilize this incredible machine to implement fiscal policy and dictate the future shape of our society? Now, that is a provocative thought to leave you with today, and it's exactly what we're going to need to explore next time. Thanks for joining me on this explainer. Keep learning and stay focused.